All right, we're gonna go live from now. All right. Hey, Dustin, how are you?
Hey, I am good. How are you, Hamid?
I'm good. I'm good. So, episode 3. Let's do it. There's a bunch of stuff happening, right? Stuff at
There's a
macro
bunch of,
level,
you know, uh,
micro
there's
level.
been a lot. There's been a lot happening, but I just have the podcast on our mind. I can't stop thinking about this podcast. And
Oh,
I've
I
been
love.
workshopping. I've been
Okay.
workshopping some slogans.
Okay.
Really, just a slogan.
Okay.
I
This is
want to
the
see how
first
you.
I'm hearing it, by the way. This is not rehearsed or anything. So
No, it's not rehearsed. Where the
no,
investments
everyone's
are.
gonna be skeptical as to whether it's actually rehearsed. Go ahead. Go ahead.
Buy, hold, rant. Where the
Yeah.
investments are real and the advice isn't.
Okay. I like that. I like that because this is not investment advice.
It's
This is
not right because we keep forgetting to say that at the top. So I'm like, we need, or maybe,
somebody's gonna get
oh
us. Gotcha.
yeah, always real investments, never investment advice, something like that.
I like that too. That sounds like a
Yeah.
good slogan for like savvy trader too, in general.
Well, yeah, we could do that.
Oh, by the
Bring it
way,
to the product.
is the new copy portfolio feature live yet on Savvy Trader?
Let me see.
I love this new feature that you
I
added.
don't think it's live yet.
Okay, for anybody listening to this later, if you're looking at a portfolio on Savvy Trader and you just want to see what it would take to copy it with like $1,000 or $5,000 or whatever, $50,000 or $1,000,000, you can put in the amount and
This
it'll
is the
tell
old
you
version I'm
exactly
showing.
what you would need to buy. Yeah, it's kind of like this screen, but except it's more optimized and better, and it's called the
Yeah,
copy portfolio, right? So
yeah,
look
and
for
that
that. It should be on the portfolio screen.
my guess is it'll probably go live while we're talking.
Yes, probably true. Okay, I like those slogans, but probably not for the podcast, right? Like,
Well, yeah, we just need to remember to say this is not investment advice.
oh yeah,
Um, which, by the way, this is not investment advice. Okay, let's talk markets.
we beat that
Uh,
one.
so the market's been pretty red the last like 2 days.
Yeah,
Should we be worried? Should we be selling everything? Should we be buying everything? How should we be thinking
I
about
mean
this?
the
What should I do?
the markets don't go up every single day. I thought the stock market is one directional.
That's
Well,
how
you
it
know
should
what's
be.
funny is that my portfolio has gotten pretty hammered. Or this morning it was down like 3 or 4%. It's actually recovered. Oh, we're closed now, so I'm down 0.6% today, which is not
Yeah,
too
at one
bad.
point Rocket Lab I think was down over 5% today.
Yeah, I got notifications for both Rocket Lab and Robinhood being down more than 5%. So my
Mm.
portfolio in particular has gotten hit pretty hard last 2 days. Like yesterday in particular, it was down over 4%, if I'm not mistaken, and then today down 0.6%. So it's not so bad. But you know, like one of the things I keep coming back to is on days like today, I come back to this chart, which is the performance chart, and you know, like I look at it for year to date, which you know, like right now, year to date is still looking pretty fantastic. It's, you know, up over 60%. So you know, I'm not super worried about it on a day by day basis compared to the S&P, by the way, 9%. So um,
You know what
you
that's
know,
called, Hamid? That's called when in doubt, zoom out.
but when in doubt, zoom out. That's right. That's right.
Yep.
So you know, you have a long-term perspective, then you sort of can uh, ease through it. Now, does it not feel good when you see your portfolio down 5% or 10% in a week, as it happened, for example, in April back here? You know, like during the tariff uh, wars or whatever that happened, and even the previous month before that, it was pretty terrible, where it was like everything was dropping quite a bit. Yeah, it sucks. But you know, when you have a multi-year perspective, it none of the sort of macro stuff seemed to matter. One of the things that was spooking the markets, by the way, is the macro stuff. Like apparently, Fed chairman was scheduled to talk this morning. I don't even know what he said, because to me, like, none of it matters. Yes, interest rates might go down, and they might not, by the way, because he's very, very slow to move. But that's been literally the nonstop news for the last year and a half, 2 years, that people have been waiting for interest rates to go down rapidly. And every time it seems like it's going to get delayed, the markets go down momentarily, but then they recover. And then, like, great companies continue to do well. And the market has ripped over the past year and a half, 2 years. So worrying about that macro stuff is generally feels like the wrong thing for me, because I'm not buying and selling on a daily basis anyway. So
Right.
yeah.
Yeah. The last time I checked the probabilities, which was a couple days ago, it was like a 90% chance that they were going to cut rates by 25 basis points in September. Now,
but
with that said,
the case for a few months ago for the meeting that they had, 2 months ago, that it was 90% probability.
It's not always right, and the probability is closer to being more and more correct the closer we get to the meeting. It's just it feels it out. But with that said, if it is a 90% chance and it remains that way, which again I haven't checked today, so it could be totally different. Then at that point, it's going to be priced in anyway, and the market's not going to necessarily react when the cut happens.
Right. But let's say, for example, Fed chairman says that, no, we're not going to cut because we don't have enough data or whatever, which is literally what he's been doing every single time for the past several times. Yep. That people have also wanted a rate cut. And what happens in the immediate aftermath is that the market drops. Right. But then by the next day or week, the market has already recovered. So how are you supposed to use that information to make investment decisions, especially if you're a long-term investor? And the answer is, as a long-term investor, I don't use that information. I kind of ignore the macro stuff. So there's only sort of one high level macro thing that I look at, which is if prices are overly inflated on the things specifically that I own, right? But also if the entire market is overinflated, as it was during the dot-com era, for example. I don't think we're anywhere close to the dot-com era in inflated numbers, because back then it was just sort of a different level of exuberance that I haven't seen since then. I think there's been a lot of caution by investors who are old enough to remember that. So. Yeah.
And so how do you think about when there's big price moves within your portfolio? Is your gut reaction to just, hold and not do anything? Or
yeah. Yeah, 100%. So, actually a perfect example of that would be Rocket Lab in the past few days. Let me pull that up real quick. So if we look at Rocket Lab over the past month, it's down 13%, right? So there's Rocket Lab's numbers. It's down 13%. Today was down 5%. It kind of recovered actually, and ended the day down only 0.5%. So not too bad, but yeah, I generally just hold through it, and I don't get phased and want to sell. In some cases, if I think the valuation has come down too low, then I start buying, and that's what happened in April, for example, with the tariff issues that occurred. So right now, I haven't bought any additional Rocket Lab, despite it being down 13%. But it gets more attractive if it goes into the 30s. It's more interesting to where low 30s, right. I should say. Definitely the 20s, I'd be a buyer of Rocket Lab again. But right now, it's a decently priced stock, right? It's not too low, it's not too expensive. It's decently priced. Now, if it skyrockets from here, then I might sell some, because I think it would be getting ahead of its skis. But the future for Rocket Lab, a company like Rocket Lab, is very bright, because they have the Neutron rocket that's coming, that's reusable. That's the Falcon 9 competitor. They have a lot of satellite technologies that just continues to grow. And there's all indications are that satellite technology is just going to explode from here. It's not going to we're not going to need fewer satellites, that's for sure. Starlink has shown what a lucrative business that can be. Starlink has grown from $0 of revenue to, it's probably going to do somewhere close to 12 billion, 15 billion. The numbers are not exactly public, so it's like a glimpse every now and then that Elon gives on Starlink revenues, but it's in the teens of billions of dollars from zero, just like 5 years ago. And that is an incredible growth rate, right? Like, what company other than OpenAI has grown that fast from zero? There's only like two, OpenAI and Starlink. So I think that we're going to see a lot more satellites. So Rocket Lab is in a great position to grow as the space industry grows. And that's why I love it. But its current price is not cheap, right? It's trading at more than a 20 multiple of price sales ratio. And anytime you get into above 20, that's a pretty expensive stock. So
Yeah. So basically, you kind of do the opposite of, I think, what human psychology kind of wants you to do, right? Like, it's when the price drops down,
yeah,
tend to buy if it drops down enough, and if it goes too high, then you start to sell, which is where it's what I need to work on. I don't do a great job of taking profit as the price goes up. I'm okay at buying when the price goes down, but it's the greed that gets me.
Well, like on great companies, as you take profit as the price goes up, it just tends to long term keep going up anyway. So you always have this regret of like, oh, I should have just done it all, like you had just, like at one point I was early investors in Apple in like 2000, right? Like when Steve Jobs came back, I was like, yep. But then like by 2012, I was completely out of Apple, right? But Apple continued to run for a lot more years. But then like when I look at, I invested in other things that did exceptionally well, right? In 2012, I started maybe 2013 when Netflix had the division of DVD business from its streaming business. Its stock price went down like 75% overnight, but the business was just as solid as ever. But because of that decision to split up their DVD business and streaming business, the Wall Street was just like, this is dumb. Like, they punished them, right? So I bought it on sale, and the price just kept going down further and further, and I bought more and more. And then once it like started tripling and quadrupling, and then 5-timing and 10-timing, I had sold the vast majority of it. I think the last bits I sold at like 12 or 15 times what I bought it at. But today is probably, from the 2012 prices, is probably over 100 times what I bought it at. Right. So, you always have this like little bit of like, oh, if I had held on to it, but taking profits, I think, is important. And
I think it's just mentally healthy to do.
Right.
And it's also nice, like, once you get your investment back and the rest is just like gravy,
right. Yeah, 100%. And also, it makes days like yesterday, where my portfolio was down, or like Rocket Lab and Robinhood were both down more than 5%, easier to digest, because I'm like, well, I sold some, like of both of them, a Rocket Lab in the 50s and, also the 30s and 40s, but and Robinhood also as high as 112 or somewhere in that neighborhood. But so it makes the bumps easier to take if you've been taking profits along the way.
Right. Should we get into earnings this week?
Oh yeah, let's do it.
Okay, so
we do have this product called Earnings Hub.
Yeah, we have Earnings Hub. The best place to find earnings information. Let's start with Intuit, which hasn't reported yet, but reports tomorrow. Intuit is, to me, a very interesting business at a personal level. I used to use 3 of their products. I used to use MailChimp, Mint, and I still use TurboTax.
Right.
And this is a company that I was thinking about buying for a very long time, but then I kind of fell out of love with them. They shut down Mint, which was a really interesting story. So basically, they shut down Mint. They also own Credit Karma, and they tried pushing users to use Credit Karma instead to track their finances, which
Right.
really made sense. But regardless, both of those products is just a funnel to get users into TurboTax. And it
Okay.
was just Credit Karma was they found was a more optimal funnel than Mint. And then MailChimp, as you know, we use it at Savvy Trader and Earnings Hub, and
Yeah.
we decided it was too expensive, and we
Right.
just built our own. So, like,
It's
which
not software
it-
for people.
yeah, but it makes like the moat for at least some parts of their business questionable. What they do have as a strong product, in my opinion, is TurboTax. I think it's fantastic, given it's not tax software is not fun, but to make the convoluted tax code
Here,
usable, user friendly.
I'll tell you how
Yeah,
I think about Intuit, right? Like, or a company like Intuit. It's a tech
yeah, please.
company. Uh, it's a tech company, and then like when we look at the fundamentals, which is like this, the earnings hub score, I consider that the fundamentals, right? Um, we're basically looking at a company that has uh, a price sales ratio of 10, so it's not cheap. A PE ratio of 36 for a very mature company that's growing at roughly 15% on revenues, right? So 15% revenue growth is obviously good, but it's not great. Like even Meta, as big as it is growing at closer to 20%, and it has a lower PE. So would I want to own Intuit over Meta, which is at the forefront of the technologies and far more likely to do something incredible and release something that uh, causes a huge amount of excitement by users? Well, Intuit is probably not going to be the company that does that. It's probably going to be Google or Meta or Apple or those other companies. So if one of those companies is growing faster, has a lower price earnings ratio, has a lower price sales ratio, then why would I want to own Intel over one of those companies, right? Or Intuit, not Intel. So that's the way I look at it. And but is it a good company? Yeah, it looks like a great company. It's been growing solidly. When you look at their revenue chart, uh, they've beaten revenue estimates 13 out of 17 times, but it's not an exciting company as far as I'm concerned. So yeah, I
Yeah,
would
I
pass for.
loved at one point how they were touching so many different pieces of my life. I was like, man, this is unique for a tech company to do this.
Right.
And then, sure enough, they've been falling out of favor, and at least for me. And the
Yeah.
numbers don't support the business.
And if you bought stocks in that way, meaning you bought stocks in companies that you used, which is sort of like Peter Lynch. I learned a lot of my investment thesis from that book that he's written called One Up on Wall Street. Um, Peter Lynch has like some great suggestions, and one of the ways that he suggests that retail investors or just the ordinary Joe can do even better than Wall Street people investors is by buying the stuff that they use. And in this case, you would have done really well. In the past 5 years, you would have bought in the 300s range, and it's more than doubled from that price.
Don't tell me that.
Well, you've done much better than just double, but I'm saying the average Joe
That's what I want
doubling
to
in
hear.
5 years, that's pretty awesome. That's better than the S&P
Yeah,
500.
that's true.
So
Okay, let's shift
actually,
over
it's
to
better than the S&P 500. I'm saying that, but I might be wrong.
I
It's
think
slightly better than the S&P
yeah.
500, but yeah.
Let's move over to Zoom. So Zoom also reports tomorrow, and this is a stock that you used to hold in the past.
Yes.
At least I don't really remember your journey with it. I know when we first met, it was like we were still kind of getting out of the COVID era, and it
Yeah.
was in your portfolio. So did you buy it during
I
COVID or?
I bought it in the low 100s. I want to say maybe 140, 150, and then I sold the vast majority of it in the like high 400s. So this sort of mountain climb, I was like, okay, now it's way overvalued. And then I bought it again when it fell below 100 post-COVID. because I thought that the company was getting slammed too much. And even to this day, its fundamentals are pretty solid. It has a price earnings ratio of 12.9, price sales ratio of 4.6. For a tech company, that's pretty incredible. The reason that Zoom has gotten out of favor and has struggled as a stock price, not as a company. The company is continuing to thrive. It's having more profits than ever. It's pumping out cash. But the reason its stock price has gone out of favor is because it doesn't have growth. And any company that doesn't have growth gets punished pretty heavily. So its growth rate is only 3% of its revenue in the past 12 months. So because of that is why the stock price is suppressed. So when
I
you
think
look
there's also an element of the sentiment just being like it's a COVID stock,
That's
and
right.
I think that's spooking investors as well.
Right. And these guys also had the best product by a mile at the beginning of COVID. And at the end of COVID, they, like Google Meets and Microsoft Teams and, other products essentially were just almost as good or good enough to where like you could get away with using somebody else's product or Google Meet and be fine, as opposed to Zoom. So that's the other reason that I think that they kind of fell out of favor, is that the competition is pretty strong and it's from Microsoft and Google, and they haven't innovated. They were slow to adopt AI. They could have like really adopted AI much more quickly. Yeah, they haven't really innovated in the way that you would expect a small company like that to innovate. So,
Right. Okay, let's move on to some companies that did report. So Home Depot and Lowe's both reported. Home Depot reported yesterday, and it did not meet expectations.
Home Depot
And
didn't.
did
The
not. No,
stock
not
price
by.
went up.
Yeah, not by much. They missed by less than 1%.
Okay.
So
I
I
wonder
don't know what.
and was the way it was. I wonder if the whispers were that they were going to miss even further.
Right.
This stuff,
Or
I guess,
maybe something was said during the call. And then Lowe's reported today, and they beat expectations.
okay.
Also not by much, but they beat EPS expectations by over 2%. So,
Got it.
but I figured, we don't have enough fun on this podcast, so I want to do something fun.
Okay.
A little would you rather. Would you rather buy Home Depot or
Okay.
Lowe's?
Or
And
Lowe's.
how are you looking at these two stocks? What numbers do you look at?
Okay. Again, going back to the fundamentals, I start with the earnings hub score, and I don't mean just the letter grade of like A, B, C, D, which is how we sort of score them, just to make it simple, but the details of like the market cap, the price earnings ratio, the price sales ratio, the trailing 12-month revenue, and then the EPS and its growth rate, right? So when I look at that information, I'm looking at for Home Depot, I'm looking at revenues that are growing at about 8% annually. I'm looking at a price earnings ratio of 26, which is, high-ish for like retail, I suspect, company with only an 8% growth rate. And price sales is fine, 2.5, it's not bad. And then if we compare that to Lowe's, so let's select Lowe's here. The PE is 21, so it's in the same ballpark versus 25. Now Lowe's has negative growth, so minus 0.5% revenue, like decline, instead of increase of 8.5% for Home Depot. And if the price earnings ratio is similar, and their profits, by the way, are also like not growing, plus 0.7%. So if the price earnings ratio is similar, it's in the same ballpark, and Home Depot is the number one company in this space versus Lowe's, I would way rather own Home Depot over Lowe's. So if I had to pick one, I would pick Home Depot. But
the other thing I like,
I own neither, because at these kind of prices, I prefer faster growing tech companies as opposed to retail.
yes, to be clear, it is a total imaginary scenario. I would never expect you to buy one of these companies. But if you were forced to, it would be Home Depot.
Home Depot, definitely.
The other thing I like about Home Depot is that they're just the bigger player. I tend to like to
Right.
invest in like the number one
And
player
number
as
one.
opposed to
Number
number
one
two.
tends to do way better than the number two as a stock as a stock. Like, number one EV company in the US is Tesla, over $1 trillion valuation. Number two is Rivian at
Right.
$14 billion valuation to my but which one has more potential in this particular case? I would say Rivian.
Right. Well, that's what you get sometimes with the lower market cap is it's easier to get those multiples.
Right. But if Rivian, for example, had similar sort of price sales ratios as Tesla, then it would make less sense to own Rivian as opposed to Tesla, right? So part of the reason that Rivian to me is so attractive is its revenue growth is probably going to be substantially more, and its price sales ratio is significantly less today. So both of those things work in Rivian's favor as opposed to Tesla. That's why I own Rivian over Tesla.
Yeah.
Although I know we won't go.
No, you always manage to get your stocks into the conversation. I know that. Always got to push your own book.
No, I'm not.
Joking, obviously. Going back to Home Depot, as you know, I recently bought a house like a little over 6 months ago.
Yeah.
And I never appreciated how great Home Depot is until now. Like I am there all the time. I basically live there. There's no reason for me to own a house because I'm just there, Right. But I think it's a great business.
Put up a room in there.
Okay, let's do one more. Would you rather?
Okay.
In regards to this week's earnings.
Okay.
Target and Walmart. So Target reported this morning they beat their earnings slightly. Well, they beat their revenue estimates. EPS was right on target at $2.05.
You love those puns, don't you?
You know what? I wasn't even trying for that one.
Okay.
But I do love my pun. It's the dad jokes in me. It's only getting worse. And then Walmart reports tomorrow morning. So which one would you buy?
Okay, so I gotta look at the same type of thing. So let me looking at Target, we have a negative revenue growth of -1.5%. So that's not good. Negative EPS growth of -20%. So their profitability is like going down pretty rapidly. PE of 13, that seems pretty low, and price sales of 0.5. Okay. Now let's look at Walmart, which is like the number one. So by default, if all else the same, Walmart would
definitely zoom in a little.
Oh yeah, thank you. So if all else was the same, Walmart would be the one to go for. But when you look at the PE of 40 versus 13, that just is not attractive for a retail company that's growing at just 4.2%, EPS growing at just 8%. Those numbers are just like, why would I want to own Walmart at all? Not that Target is any better, especially with declining revenues. The 13 PE is better. At least they're pumping out more profits on a per dollar of sales, but. Yeah, this is one of those situations where I don't want to own either one of them. I don't want to own Target because it's a declining company that is not super cheap relative to other retailers. But and then I don't want to own Walmart because it's so freaking expensive. Who would want to buy Walmart at a PE of 40 and a growth rate of 4% when I suspect even Amazon is growing faster than that, or has a lower PE? Yeah, Amazon is growing at 10%, 11%. With a PE of 34. And it's a tech company. And between Amazon and Walmart, which one is more likely to do something incredible and create a product that just the world loves, right? So I would way rather own Amazon over Walmart. But again, going back to tech, Google's PE is 21. That's way better, faster growth rate than both Amazon and Walmart at 13%. And then, Meta is is PE of 27, better than Walmart and Amazon. Not as good as Google, but growth rate much faster at 19%. So the tech companies seem way more attractive to me in this scenario. And the tech retailer Amazon has both the retail side of it covered, which is Walmart's business. I think they're doing a much better job than Walmart, growing at a much faster pace, more profitably, and the stock is actually cheaper than Walmart on revenue and profits basis. So again, one of those things that it seems like a no-brainer to pick the tech company instead of the retailer.
Right. Okay. Are there any other earnings you want to hit on for this week, or should we move to your portfolio?
No, this week we don't have anything else. What's going on next week? Oh, next week we got NVIDIA. That happens during our podcast, so that should be super interesting. We should talk about NVIDIA next week during the live.
Yeah.
Snow, CrowdStrike. There's a bunch of them next week. Okay, we can move on to the portfolio if you want.
Cool. So I think we had a question from Eagle Eye about your portfolio.
Okay.
What are the reasons that you're doubling down on Bumble and you pulled out of SMCI?
Ooh. Will I invest more if the price drops to 3? Okay, so that part is super easy. All else equal, meaning if nothing has changed about Bumble, like if there's no news, we don't know anything different other than people decide to sell their shares and therefore the price drops pretty heavily. Yes, I would buy a lot more at 3. At 3, it would value the company at around what, 350 million, somewhere in that neighborhood, maybe even less, maybe 300 million, because they have about 100 million shares outstanding, so roughly 300 million. So the question is, and they're by the way right now generating roughly $60 million of cash per quarter. So the question is, would I pay $300 million for a company that is generating $240 million of cash at that kind of a run rate? Nothing else changing. And that's just like a no-brainer. Of course I would buy it. Like I would go all in, like unless something was wrong and rotten that we don't know about, I would probably bet very, very heavily on something like that. Now, even at 6 or 7, it's attractive, and I've been like buying a lot more shares of Bumble. And I did decide to sell SMCI because fundamentally I am not as impressed by the founder of SMCI as I am by the founder of Bumble, both founder CEO companies. So when I started buying Bumble, Whitney Hurd had not come back yet to run the company. That's the founder. She's the girl behind Tinder and Bumble, 2 major dating apps, the top 2 of 3 major dating apps in the App Store. So she came back March 17th, and my hope for when she comes back is that she would reduce costs and make the company even more profitable. And basically do what Mark Zuckerberg did in 2022, 2023, where he sort of called it the year of efficiency, where he let go of over 20% of the staff and really like hunkered down and focused on product and improving the business. And that's exactly what she's done. She's let go of 30% of the staff, changed out the entire executive suite, and has gone on record admitting the product's shortfalls and all the things that people hate about the dating apps, not just Bumble, but including Bumble. So whenever a CEO, and by the way, only founder CEOs do this type of thing. Whenever a CEO comes and says, you know what, our product is shit or sucks because of X, Y, and Z, and unless we fix these problems, we don't deserve to grow, right? It's impressive, and that's why I decided that my SMCI bet probably deserves to be on Bumble as opposed to SMCI. So not that those really should have been compared anyway, but I didn't want to use more of my cash. That was the main reason I sold SMCI to buy Bumble, is because I wanted to maintain my cash level.
Why not? So you didn't want to increase your cash level either, like if you just sold SMCI and just held the cash around?
Well, currently I'm comfortable having around 20 to 25% of cash. Like I don't feel like the markets are super overvalued to where I want to go 30, 40% in cash. And I don't think they're way undervalued to where I want to deploy more of my cash. But if Bumble went down to $3, I would definitely deploy a lot of my cash without selling anything else and just go a lot more into Bumble.
Going back to like Whitney and having the POV that like the product sucks, it reminds me a lot of Meta and Mark Zuckerberg, where he wasn't necessarily specifically saying that the product sucks, but like it seems like social media is fading, at least the interest in it. And this was an example of like actions speak louder than words when he was like, okay, we need to go all in on the metaverse. And then, now it's more AI. But irrelevant of what the pivot is, it was very clear to him that a pivot needed to happen. And I think you're spot on. If anyone else was running Meta at the time, they would still be solely focused on social media and not be doing any of these moonshots.
Yeah, absolutely. And in fact, Meta could generate an extra, I think somewhere around 20 to 40 billion dollars is the estimates of profits if it just like eliminated most of its like what a lot of Wall Street analysts think is like wasteful spending by Mark Zuckerberg, right? So imagine if you were like a CEO, you come in, the easiest way to like make the stock price go up would be to make the company twice as profitable as it is now. And I think you would be handsomely rewarded by Wall Street. But then where would the company be in 5 years or 10 years?
It's a short-term benefit. And
That's
then
right.
long-term, you're screwed.
That's right. And that's why like I love founder-run companies, is because they don't care about the short term. They're like, I could care less what happens in the next year because we have enough cash to survive, even if we lose, lose our profitability overnight for some reason, which in Meta's case would never happen. But their viewpoint is very long-term oriented. They're like, we need to position ourselves so that we beat Apple in Zuckerberg's case in the next product that every consumer is going to have, next tech product. And Zuckerberg is betting on AI glasses being that next tech product that replaces your phone. So if you have these glasses and they can talk to you and you can talk to it and they can see what you see and they have all day battery life. So just just imagining a regular pair of glasses like this that has all of the same tech as your phone, but like built in so that you can kind of like have heads up display. That future would be like owned by whoever creates these type of glasses, and that's what he's betting on. And in September, they're going to release the first version of their smart
glasses. That's what I was going to ask. I thought I saw something about that.
Yeah, like literally next month they're going to announce it, and the expectations are that they're going to be priced at around $800. This is the other thing that I love about founder-run companies is they understand that price matters. Right. One of the things that Tim Cook doesn't understand anymore at Apple, this is something that was lost with losing Steve Jobs, is that Steve Jobs always knew price matters. And Tim Cook doesn't understand that price matters. He released a $3,500 headset. Like, who is going to buy a $3,500 headset? It doesn't matter how good it is, right? When by the way, the alternative costs only $500. So, yeah, Meta's strategy under Zuckerberg is like spot on, and it'll be interesting to see what they come up with. Google has had their glasses technology, for example, being built, and they were the first to come up with Google Glass, for example. But
yeah,
they just lost their mojo when like the founders have kind of stepped back and they're kind of in it and kind of not. And then it's run by Sundar, who's like a nice guy, brilliant engineer, but he's not doing the hard stuff at Google.
Yeah, so your share
Google if it wasn't for Sundar. And I like, honestly, I get so frustrated with it. I'm like, maybe I should just stick to my founder-led companies and get rid of Google.
Well, yeah, it's funny that you say that because like, it's very clear, at least to me, what companies you're more excited about versus others of the ones that you own, because it's the ones that you just like are constantly talking about are the ones that you just keep and you end up buying, and then the ones that you don't talk about as much, but you're just holding, like an SMCI and a
Right.
Google, like
I
those are
talk
the ones
about
that I
Google a lot, to be fair, but it's always in a
but
negative
it's
way.
never good. Yeah, no. Typically, when you're talking about Bumble or Hood or Meta, it's always like everyone's missing this opportunity. Like, what are you
Right.
doing?
That's
And
right.
that has not been the conversation with Google. It's been
Like
that they don't own
Google is
Gemini.com.
yeah, well, Google is missing the opportunity, right? Like look at, for example, their Pixel 10 announcement today, right? Like
Yes.
who wants the 10th version of a phone, right? Like iPhone 16, like was supposed to be all about AI. And for a moment, we got excited because Apple was going to give us AI built into the phone, but then it turned out to be a dud. Google has an opportunity because Apple has completely fumbled on AI, completely fumbled. So instead of Google Pixel 10, they should have given us the Pixel AI, right? Like it should have been all around AI. And I should be able to just talk to my phone to do things inside of the apps that I use every day, right? I need an Uber. I should be able to just push the button on Google and be like, hey, I need an Uber, pick me up in 10 minutes or as soon as possible or whatever. And it should just go do that for me in the Uber app. I shouldn't have to even open the Uber app, right? Like that
And,
was
and
it.
I think the bigger deal, at least the way I kind of see the future of things, is there shouldn't have to be an Uber API or integration.
No,
Uh, like it should just work. And it's kind of similar to how robots work, where like everyone's building humanoid robots because the world is built for humans.
that's right.
So the AI should be built to just interact with apps as they are. That way it just works across all functions.
100%. It could just
Yeah,
like it could even just show the app getting opened and the AI using the
exactly.
app as I would use it, and it could like come back with, by the way, an Uber X costs $18, and Uber Black costs $40. Which one would you like? Ask me questions, follow-up questions, right? And like they're missing it. They have all the tech to be able to do this, right? If Google Pixel AI did that, they would just destroy the iPhone. I mean, like, there's
And
no way that one could catch up to something like that.
I,
And imagine those demos and commercials where like the person is just talking to their phone to do what it should do, and inside of the apps, showing that the apps are getting used by the AI to do the things that you want it to do. It would just be mind-blowingly awesome. Anyway,
yeah, I think Google did hint at this at Google I/O back in, I think it was May, maybe, where they showed like a little video. It was like a kid fixing his bike and talking to his phone, and it was doing all this stuff. But like, who knows when that'll actually appear? And it wasn't like a real live demo. It was, pre-recorded and whatnot.
right.
But I will say, like, just we agree where we want all of this to go, but in terms of what's available today, I do think Google phones are leaps and bounds ahead of the iPhone when it comes to AI integrations and like the functionality they bring. Like Google was showing off some stuff today in their Pixel 10 event called, I think, Magic Cues,
Yeah, I
where
saw
like,
that.
let's hypothetically say we're going to Austin, sometime in the near future to hang
Yeah.
out. Total
Mhm.
hypothetical. And I'm like, oh, did you hear American Airlines is canceling some flights? And I text you that on your phone. It would show you, or a button would appear to call American Airlines. You could hit that, and then on the call screen, it shows you all of your flight information that it pulls from Gmail.
Right.
So
So
it's
I
like
mean,
all these really nice integrations. It's not just
yeah,
it's not a there's two types of ways to interact with an AI. It's telling the AI what you want versus the AI just doing something for you and anticipating what you want. And they're doing a really good job with that. And it's in some
anticipate.
ways, I think, easier for them to do that, which is, I think, a little anti-intuitive.
Yeah, the anticipation part, I think they're doing a good job. Maybe like I can't like Google Calendar. We did the bookings of our flights today to Austin, right? Like I had to go and put those things into my calendar myself, And there is no way to use AI to do that and just copy and paste like a screenshot of my confirmation and say, go do this, right? They have a feature in
Google.
Gmail, if you use Gmail to,
Oh, okay. I
when
was
you
gonna
get the
say
confirmation,
this is definitely a thing.
yeah, to automatically create the calendar event for you. But because it makes so many mistakes, and sometimes it creates things that, like flights that have been canceled or whatever, I actually turned off that feature. But if you turn off that feature, there is no way for you to create it from the email, right? Like calendar.
I see.
So, there's a lot of like little misses at Google that, like I think AI could solve a lot of these things for them. Like Google Calendar should have AI built in right now, right? I should be able to talk to it and say, can you schedule, a 9 a.m. meeting with Dustin and have the subject be, discuss the buy hold rent podcast, right? And it should be able to do
Right.
that and send an invite to you, but I can't do it. So there's a lot of things that they're missing. They have all the tech. They have the Pixel phone. Apple right now is fumbling in the biggest possible way with AI and their phones, and Google has an opportunity to leapfrog them. And what are they doing? They're releasing the Google Pixel 10 that looks exactly like the Google Pixel 9. And by the way, all of the sort of functionality of the Google Pixel 10 is, all the reviews are like, it's got better cameras, it's got 3 cameras instead of 2, and whatever. But most of the important stuff is software based, kind of like you mentioned already anyway, which is going to be even available in their previous phones. So they're not doing anything
Right.
on the phones. So,
Well, at least they're not over promising and under delivering like someone else. That's a
well,
feature.
Apple is a whole nother rant, but like the difference is Google has the tech, right? Apple doesn't even have the tech.
Well, what I'll say about Apple is it is historically very normal for Apple to be late to the game. And that's
Yes,
typically okay because they really optimize the user experience and end up doing it the best.
right.
The concern here is AI is very different than like they were very late to like copying and pasting on the iPhone like
Right.
years ago. Like that's a much smaller feature that they were able to perfect and whatever.
Or smartphones in general. Like smartphones were a thing
Yeah,
for like almost a decade when Apple came out with theirs, or iPod when MP3 players were already, there was over 100 MP3 players when the iPod came out. So that's a great argument that Apple lovers are like hanging on to. But like for those who understand the industry and have been around for a long time, they understand that argument does not hold water when it comes to AI. They had a chance to catch up with iPhone 16, and I think they promised all the things that seemed like they were going to catch up, and it was super exciting. But clearly, they have fumbled in a pretty massive way. And AI in the past 1 year has like leapfrogged another like 4x, maybe 10x the capabilities that it had a year ago. So how do you like you haven't even delivered the capabilities you promised a year ago, and now AI is like 10 times ahead. So there's a lot of hesitation that Apple will be able to sort of catch up from behind. The other thing that they don't appear to be doing is they don't appear to be buying and making all the investments necessary in GPUs and data centers and the
right.
talent necessary to bring all the pieces together, right? Who is doing that? Well, Meta, Musk with XAI. Google already had most of the talent. They just sort of have fumbled, but like, and obviously OpenAI. So if OpenAI released a phone tomorrow that did some of the things that I'm talking about, they might destroy both Android and Apple.
I'm very curious to see what that ends up being. If I had to guess, I think it's going to be a letdown.
Yeah,
Just my gut. I don't think they'll be able to crack it, at least with their first attempt. The other red flag I
it would
have
be
with
horrible.
Apple,
Yeah,
right? The other red flag I have with Apple and catching up is before all this AI stuff, there was just Siri and Google Assistant, and that was like Google Assistant was way better than Siri
right.
ever was, and they never caught up from that perspective. So I just have a lot of hesitation when it comes to like Apple's future with AI, and maybe they will just outsource it or continue to outsource it to OpenAI and others.
All right, we have a question. Do you want to read it, Dustin?
AI ideas are great, but intelligence using AI has to deal with data and privacy, which might not be easier in all countries. Any mistakes will cost them, and hoping it will be easier going forward. So I guess it's a concern over data and privacy. Like, I know China specifically bans a lot of these AIs and could make, arguably, some of these products moot, or you really have to change how the OS works if certain AIs are banned.
Yeah, I mean, there's an opportunity here to sort of take advantage of the lack of regulation right now on this stuff and release features that maybe push the privacy issue a little bit around the edges, but then see what people like and love. And if people love it, then the laws will automatically shift towards that direction, so that maybe your screen can be viewed by AI, but like that information can't be stored by Google or whoever is doing it.
Right. Yeah. Adrian, any other listener questions?
Adrian, we can't hear you in case you are talking.
I wasn't talking. I was just bringing up. This is another question about SMCI.
What other than the founder has broken in your thesis for SMCI? Actually, the thesis for SMCI is still sort of like solid. And I suspect now that I have sold SMCI, it'll probably do really great, by the way. No, so, again, looking at the data center spend by all of these large tech companies, it doesn't seem to be slowing down. And SMCI is in a pretty great position to take advantage of it. Now, the reason that I decided to exit the position is because I've now, one of the things I do when I buy a company is I listen to a lot of interviews and anything I can find where the founder is talking. So the quarterly calls, direct interviews with them, that sort of thing is super exciting to me. And every time I've listened to SMCI's founder, and his name escapes me right now, but I've had a lot of trouble understanding what he's saying. And B, there's been so many times where I'm like, I don't even think he understood the question correctly to answer it correctly. And these are sort of like things that makes you lose a little bit of confidence in the person who's supposed to like build the best team for the execution of these things and really execute. And one of the other things that I saw is that SMCI's biggest growth revenue is actually coming from the Asian market, which the founder might be thriving in the Asian markets because maybe it's more native for him and less language barriers as opposed to the US. I think a lot of these investments are also being made in the US. So I was concerned, and I'm like, all right, I'm not as excited, whereas I am excited about this other company. I want to invest more money in it, but I don't really want my cash to fall below 20% of my portfolio. So that's sort of what triggered the decision to sell SMCI. Adrian, do we have anything else?
No, but we've got some great interactions. We've got some new followers, so we're excited. Thanks
Awesome.
for listening.
Then we'll wrap it up here, unless you have anything else, Dustin. What do you think?
No, I have nothing else. I appreciate everyone listening, and I already hear people rating the podcast 5 stars, so that's great.
Okay,
Thank you for doing that.
I have one more that came in. This is from user Igor.
Okay.
And he says, let me put it up on the screen.
I just put it up for you.
Yeah, what's your opinion on Sam Altman stating we may be in an AI bubble? I haven't heard him say that, but let's assume it's true. He is sort of not wrong in the way that the spend is happening, right? So XAI, as an example, is Elon's company has spent has now raised a ton of money at like $200 billion valuations. They've raised over like 20 billion, building rapidly as fast as they can. And Elon is like really pushing in every X post about using Grok Imagine to go, like bring your pictures to life. And he's upset at Apple for not featuring Grok. So, clearly he's realizing that the spend is outpacing the revenue opportunity for at least Grok. OpenAI, I think, has enormous revenue growth, so they're in a fairly safe spot, and their product continues to be the number one in terms of usage and user base that's growing rapidly. So if I was evaluating it, I would evaluate it on a company by company basis. So I would see XAI probably reducing spend going forward. I see OpenAI increasing spend. Meta, I think, is going to continue to spend as planned because they're so profitable that they can easily absorb it. And in Mark Zuckerberg's view, it's better to overshoot in this case when you have the money to overshoot than to undershoot. Meaning, like, if you don't have enough capacity and someone else comes and passes you, that would be devastating to Meta, as opposed to like if they have more capacity than they need. So that's a risk worth taking. And then, I see Google and Microsoft sort of in a similar boat, but with less capable CEOs that are trying to execute in those areas. So I don't necessarily agree with Sam Altman's bubble from the AI spend on the larger companies. Now, on the private markets, so if we were to sort of go to the private sector, investments have been flowing into AI-based companies, and I suspect they're getting really high valuations. There might be a bubble happening there. Most of that does not affect the public market investors. One that might, or a few that might, are companies that have gotten such huge valuations, like Palantir, for example, that went above a $400 billion valuation at one point in time. I think it's still pretty high. What's their valuation, Dustin? Do you happen to remember?
No, I don't.
But companies like Palantir might be in a like micro bubble in the public space, but that would be sort of like my only concern there. And we're coming up to an hour, so we should probably wrap up here.
Yeah, we should. Well, thank you everyone for listening to episode 3 of the Buy, Hold, Rant podcast.
Yeah.
I'm Dustin. That's Hamid.
Wait, well, I'm going the wrong way then.
Oh, I was just talking into the microphone. But I guess.
Oh, okay. All right.
Or maybe